There is a number. Pragati is given a number to call once the if anyone wants to know more about the uh, to them. I mean, Karthik, should I message you the number?
We'll not be able to put it up on.
Okay. Hi. Hello. Good morning, everyone. And thank you so much for joining us today for this webinar on a new product opportunity that Access Mutual Fund has brought to the market. It's something that we are very excited about, and I will try to cover the brief details about this product over the next 20-25 minutes. We'll also have lots of time for taking your questions. There is a link that is being made available if you have any questions. We already have lots of questions that have come in, and I'll try and cover as many as possible. But do feel free as this webinar continues if you have any questions which you want me to cover. Like I said, we'll try and cover as many as possible. So let's jump in. The fund that we are here to talk about today is the Access Special Situations Fund. As I said, this is a new launch from Access Mutual Fund. The NFO is currently ongoing. Um, and essentially, the most important thing to know about this fund is it is what is called a thematic equity product. Now, when we talk about equity funds, broadly, very broadly speaking, they can be split into what are called diversified funds and others which are more thematic in nature. What's the difference between the two? A diversified fund, as the name suggests, can essentially within its say market cap mandate, etc., can invest in any opportunity around the entire market. So a large cap diversified, for example, can invest in any type of large cap ideas, of course the ones that the fund manager likes or which is aligned with the philosophy of the fund house. On the other side, you have, so therefore diversified funds are more broadly tracking the market, what's going on in the market, and they obviously aspire to deliver performance or outperformance relative to that. Uh, uh, on the other hand, you have thematic funds. Now, as the name suggests, thematic funds are funds which target a very specific theme. For example, this fund that we are talking about today, the Special Situations Fund. Now, the difference between a thematic fund and the diversified fund is that the minute you say that you want to target a specific theme, then obviously you want to invest in stocks which are, very relevant for that theme itself, and not generally invest in any good stock which is maybe trading. Why is this relevant, or why is this something which can be useful for investors? This answer is that if you find a good quality theme which is longer term in nature, which is broad, then it allows investors to capture a really interesting segment of the market and can really complement. Yeah, it can provide a potential for good alpha, and it can complement your normal diversified offerings. So a good theme is essentially a theme that is relevant for the long term. It has a number of stocks available, and it is something that connects with you as an investor in terms of what is going on around us on a day-to-day basis in terms of the changes that are happening. And that brings us to the Special Situations Fund theme. This fund, essentially what we are trying to do is that we are going to invest into the theme of the disruptive change that is taking place all around us. Now, disruptive change, it may sound like something that is a negative word because it is disrupting businesses which are happening around us. But if you think back about it, disruptive change actually has a lot of connotations, because when disruption happens, it forces players to innovate, it forces new players to emerge, and that is where the opportunities from an investment perspective get come into picture. So essentially what we are talking about is opportunities that get thrown up because of this disruption that is happening all around us. We'll talk about these disruptions in a minute, but these changes are either getting precipitated by new players or innovative players, or are forcing existing players to make innovation, and that we feel can create sustainable growth opportunities over the long term in a focused manner, which a good quality fund manager can exploit. Now, disruptive change, why is it happening around us? What could be the reasons for that? I think the easiest way to understand and the most visible face of disruptive change is the whole technology, internet, e-commerce space. Look at how today we are living our day-to-day lives compared to, say, 3 years or 5 years or 10 years ago. In a host of fields, right from cable TV versus OTT platforms, from ride sharing apps versus taxi versus personal mobility, from ordering groceries online versus ordering going to the market. A host of things. There is a dramatic transformation that is happening across sectors, and like I said, the internet, e-commerce, technology is the most visible force that is making this change. It is a long-term change. It is not something that has happened in 2-3 years and it will go away. It is something that is fundamentally going to change the way we live, the way businesses work, and the way winners and losers will emerge in terms of how people adopt to these type of changes. Now, obviously, I said that the technology e-commerce space is the most visible way of capturing or understanding disruptive change happening around us. But that's not the only reason. It can happen. Change can happen from any source. It can happen because of a big dramatic regulatory change. We spoke about, for example, there is a big reform that government brings in, like something like a GST, which is forcing changes in business practices, forces or unorganized players to move to a more organized way of doing business. It could happen because of certain events, like say, for example, COVID, which is a great example for this year. It is forcing people to do things differently because of the whole disruption of not being able to go out at all for extended periods of time. So the trigger can be, multiple. It doesn't have to be a fixed trigger. I said technology as the most obvious one, but the trigger can actually be anything. It could be regulatory. It could be in circumstances. It could be what one company comes and sort of changes the game in the whole sector. But what that does is it essentially means that BAU is no longer going to be the game, and companies will have to change how they operate. And look at again, great example is the way fintech players have come and changed the entire payment things around us today. Compared to 5 years ago to today, the whole wallets and the way we can transfer money and the way we can make payments, it's just been dramatic shift in terms of how we do that whole space. So this is not something that you can reverse. It is something that is will keep happening and pushing forward. Again, disruption is not new. Right from if you go step back into history, right from industrial revolution, steam engine, or internal combustion engine, from horse cart to automobiles to trains, we've seen automation. We've seen a number of phases of disruptive change happening all around us. So this is not something that is new. But why are we talking about it today? The reason we are talking about it today is it has become, it has gotten to a phase where a number of contributing factors are complementing each other and accelerating the pace of change. Right from the kind of bandwidth on the internet that is become available to all of us, availability of smartphones that all of us have, the fact that we are doing this webinar so seamlessly, that all of us are sitting at our homes and being able to interact and communicate with each other in such a seamless manner. The bandwidth that we have available, the smartphone apps, the technology backend that is available to create, apps and reach people, whether it is the backend in terms of the payment gateways, the big backend in terms of technology, in apps that are being created, that all these ecosystems that have been created, they are all pushing each other to further innovate and further make more changes. And all of them are pushing to make, transformation in the way we live our lives. So this is a self-sustaining loop, which is accelerating, which is pushing more and more ahead. And we think that over the next few years, this is going to dramatically change the entire way we live, as well as the way we do business. And that's where we are so excited with this opportunity in terms of why we're doing it now. There is a second reason why we think that disruption is very interesting to opportunity in the markets today, and that has to do with COVID. As we all know, COVID led to a massive shock for all of us and also for all businesses. Suddenly, businesses had to come up with ways to service their clients, customers in a completely remote manner. And suddenly, BAU was no longer an option. And that is what creates the environment for big changes. Many of these technologies, apps, etc. in India, for example, last 3-4 years, we had seen a lot of these, they were in place. For example, online grocery, or, restaurant takeaway, or educational technology. All of these were or for example, web conference technology, all of these were available. These are not things which were innovated only post-COVID. But what COVID did was that it forced people to really embrace them. And while at the adoption rates were slow and steady before COVID, we have suddenly seen a dramatic step change in the willingness. And once people have been willingly tried these things, they are not going to go back. Once you've moved from, let's say, you've tried an OTT way of consuming content, many of us will, may or may not want to go back to a scheduled time slot way of looking at content, and whatever else it entails, including advertising and everything else. So COVID has really precipitated and made that change. We've seen a dramatic shift in adoption rates, in people's use of technology over the last 6, 8, 9 months. And while, of course, COVID is not going to be around forever, but many of these changes will remain. Because, as I was saying, once you've experienced this change, it's not, many people will not undo it. So from a product opportunity perspective, therefore, we felt that this was a really exciting time with all these changes happening all around us. We are also seeing a number of these technology, as well as these startups are gaining enough scale. And we expect many of them to also start post-COVID enough scale with which they could actually start hitting the market and IPOing and getting themselves listed. So All in all, it's just a confluence of great factors which have come in place to really make us very excited about this opportunity. And that's where we think that it deserved a dedicated product of its own. It's a first of its kind in the mutual fund industry. I don't think there is any other dedicated product that allows you to participate in this theme. The other USP of this product also is that we recognize that a lot of disruption is global in nature. It's not restricted only necessarily into India. And therefore, if we have to capture this in a holistic manner, from a portfolio perspective, we cannot just limit ourselves to Indian changes, but we have to be able to capture global disruptors as well. So we have kept the provision within the portfolio for up to 30% of allocation to global disruption stocks as well. And the core, of course, 60-70% will be into Indian stocks. So in a sense, from an investor's perspective, this allows them to really capture that entire ecosystem, whether it is in India or abroad, and in whichever shape it is. With that, let's just spend a few minutes in terms of how to look at disruptive change, and how can, from an investment perspective, how do we look at different players, what they are doing, and how we can identify which players, which kind of stories to look at for the purposes of putting it into our portfolio. So disruption, essentially, the most important thing to note is that uh, what we call disruptors, if I take a global example, someone like a Netflix or a Tesla, which is coming and changing the entire sort of situation in their respective industries, whether it is OTT in one context and electric vehicles in the other, is obviously the most visible face of disruption, the companies that are disrupting. But they are not the only players in the whole who are benefiting or who are involved in disruption. There is an entire value chain. So if you look at it from a value chain perspective, we think that there are three types of players in the disruption value chain, and the fund will target all three players. The first and the most obvious one is the disruptor itself. As I gave the example, in a global context, a disruptor could be someone like a Netflix or a Tesla, which is disrupting an existing sector. Uh, but of course, a disruptor by itself, there are very few. While they are very high profile, there are also many who don't succeed, and there are a few which succeed. So disruptor by itself may not be good enough to create a full holistic portfolio, and that's where the whole value chain approach becomes useful. There are two other types of players in the value chain. The second type of player is what we call enablers. Enablers are established companies which are not really necessarily disrupting themselves, but they are, as the name suggests, enabling disruption, or enabling the disruptors to carry out their business. So just to continue with the examples that we have taken, in the case of an electric vehicle kind of a disruptor, the enablers would be companies that are providing technology to this company. So, for example, companies which are manufacturing battery electric batteries, or companies that are manufacturing semiconductor chips, or companies that are manufacturing sensors, etc., all of which are components that go into making an electric vehicle. In the context of an OTT, enablers could be companies that, like telecom companies, that provide the internet bandwidth, which allow consumers to be able to consume these kind of content or in a seamless manner. So these are companies which are established businesses, but which are enabling changes or disruptions to take place. You could also have IT companies, for example, which are technology services companies, which allow people to create technology solutions, which allows them to manage this disruption or carry out disruption in their respective sectors. So that's the second part of the value chain. As I said, the value chain, we said the first part was the disruptors. The second part we just discussed was companies which are enablers to the disruptors, and the third part will be companies which are adopters. Now, what are adopters? Adopters are, as the name suggests, established businesses which had traditional business models, but which are adopting those business models in the face of changes or disruptions happening around them. So again, going back to our example, look at OTT or electric vehicles. Adopters could be in the case of OTT, a company like a Disney, which is obviously a mainstream giant, but which is obviously responding to the threat of the disruptor, which is Netflix, by coming up with, say, a Disney Plus or a Hotstar in the Indian context, and is able to respond to this threat from a disruptor. In the context of an electric vehicle, it could be a traditional car company, which is again coming up with an electric vehicle solution of its own to compete with the disruptor, which is Tesla. So to look at the value chain, you have all these three players, and essentially what this allows you to do as an investor is to capture the entire value chain and make a very a holistic portfolio from the fund's perspective, and which is what we will do. There is a fourth category of company, which is of course the companies to avoid from a disruptive change perspective, and these are companies that deny disruption or which are laggards in terms of looking at disruption, and these are companies which may be large today but which are likely to get left behind over time as disruption takes place. And we have number of marquee examples globally from such cases. We all know of companies, famous companies like Nokia or BlackBerry or Kodak, which were really household names, but essentially the entire situation changed around them, and they were not able to respond, or they failed to see the changes around them, and they went from being market leaders to really essentially going bankrupt. So those are the companies really to avoid, but the value chain to invest into will include, the disruptors, the enablers, and the adopters. So that's what we'll try to do within this fund. Just to reiterate, the whole idea is to capture the whole long-term disruptive change. Disruption is something that plays out over longer terms. Really, in terms of from a stock market perspective, these are changes that take time to to uh, to capture or to play out, or to really get reflected in the price of the company. Again, a great example is in a global context is a company like Amazon, where the company has been successfully, as we all know, it's disrupted the whole e-commerce space. But from a stock market perspective, it is consistently sort of underappreciated the changes over the last 20 years that this company has been able to carry out. And therefore, the growth path which such companies are able to bring is very, very long, or very, very can be over multiple years. And that's where a dedicated product like this really can come into the picture, where it can make allocations to these companies and let these things play out. And what we have seen from a stock market perspective is that the market is very slow to respond to these type of changes, because typically stock market tends to work a little bit more in terms of a linear change. So they look at quarter-on-quarter changes, quarter-on-quarter growth, year-on-year growth, what kind of valuation comes from that, and they tend to extrapolate that linear change. In reality, change is moving from linear to exponential, and that's where the winners really have the ability to keep surprising the market over multiple years and create that alpha potential from an investor's perspective. So that's where this fund really comes into picture, where you can capture some of these opportunities with a long-term orientation, and if they play out as per expectation, then it can really sort of generate alpha on a reasonably long-term period as well. So as I said, the other and just to reiterate is that the other thing is that this obviously is not just an opportunity which is limited to Indian markets. A lot of these changes are being done at a global level, and therefore, from this portfolio perspective, to create that well-rounded portfolio, we will look at both Indian and global stocks into this in a seamless manner. So that as an investor, you don't have to go looking for multiple funds to participate in this opportunity. Essentially, this one fund can give you the entire portfolio across sectors, across market caps, across Indian and global stocks, all in one place. And that is the beauty of this offering. So with that, I'll pause here. We have lots of questions, and just as I said at the beginning of the webinar as well, there is that link for all of you who wish to ask more questions about this theme or about what we are trying to do. I would encourage all of you to please put your questions into that link, so that we can try and cover as many as possible. We have I think more than 2,000 questions. So obviously, thanks a lot for all of you for reaching out. I'll try and cover as many as I can. But in case there are a few which remain unanswered, you do reach out to us on the phone numbers which we'll provide at the end. Um, uh, just quickly answer a few questions. One is in terms of what is the category or what is the market cap mix of this product. And essentially, as I said at the beginning, this is a thematic product. I also spoke about how thematic funds are different from diversified funds, and they complement investors, equity investors, to create a very good, well-rounded portfolio by giving them something that can provide a separate source of alpha. And therefore, because we are looking at investing into this theme, we can invest in stocks across the market cap or across sectors when it comes to this theme, whether it is large cap, mid cap, or small cap. Um, Also, as I said, from a category perspective, this is a thematic fund as well. Um, uh, there is one concern that has come in a question saying, is this because I mentioned that COVID has led to a big change in the way we all work? If the COVID scenario changes with the vaccine around the corner, etc., will that lead to a reversal in some of these things? Frankly, the answer is we don't think so. Maybe certain things were temporary and certain shifts. What we have to realize is that certain shifts were temporary and certain shifts are more permanent in nature. What will happen probably is that some of the temporary changes will normalize. The fact that we are not traveling anywhere today, or the fact that we are not taking holidays, or we are not taking flights or trains, or those things obviously is not a permanent change. It is something that will normalize over time. But at the same time, the fact that, for example, we are consuming content on an OTT basis, we are using e-commerce to do our shopping, we are using educational technology for our kids, etc. These are changes which I don't think necessarily are reversible changes or completely are linked to COVID. I think a lot of these changes will happen. For example, webinar technology, right? The fact that we don't need to call, we have hundreds of people in this webinar. Should people spend time and effort to get into a conference room in one place to listen to me face to face, when we can so conveniently do this entire thing on a webinar, and everyone can get the same interaction and experience? So certain things, I think, once you have experienced a certain change, those things will not change. And as I say, was also said in my earlier point, there is a confluence of technology changes, etc., which are happening all around us: faster computing, cheaper smartphone, higher bandwidth, more and more apps, higher investments into startups that people are making, which are making new and new products and ways of servicing. And this is all sort of a it's a circle which is pushing each other, and it is forcing exponential change upon us. And we have to recognize that it is happening all around us, and it's not going to go away. There's a question on, why this NFO in terms of ultimately, of course, this is a new product. So it doesn't really have a track record. So people have asked about the fact that, should they look at an existing fund of, for example, Axis, or look at this NFO. So as I was explaining, the NFO, the benefit of an NFO is always, or a new launch. What we mean by NFO is basically a new launch. The benefit of a new launch is basically if it can give you something which you don't really have as an option as an investor today. We believe that this offering, this Access Special Situations Fund, gives you that new. It gives you a chance to allocate to this new paradigm. It gives you a chance to get a product which is not really available within the existing offerings, either with Access or anywhere else in the market. And in that sense, while every new launch may not make sense as an allocation vehicle, But in this case, because of the whole fact that it is a chance to really participate into this very new and exciting opportunity, we are very happy for you to consider allocating to this product. Of course, given that this is an equity product, the usual caveats will apply. A certain amount, while you can always look at putting in a lump sum in the NFO, we always encourage people to look at equity investing from a staggered or regular allocation perspective. So through SIPs, STPs, through regular allocations, I think that always makes a lot of sense for any kind of equity product because of the vagaries of the markets and the ups and downs that are happening. Uh, associate Associated point is about the fact that there was a question about lock-in and about the holding period. There is no lock-in. This is essentially an open-ended fund. But of course, as I was explaining, many of these changes, they take time to play out, and for markets to recognize the power of these changes, for the companies to start experiencing the benefit of these changes. Some of these are multiple year affairs. So therefore, even from an investor's perspective, we are encouraging this to be a long-term allocation, something like 5 years or so, or even longer. And that is very really needed to get the full power of the changes, to completely play out in your portfolio or from the company's perspective. There is a question about the fact that I gave the example of Nokia, Kodak, etc., and obviously these are well-known example, and I think people said the question is saying that these are obviously well-known and after the fact. See, the reality is that obviously we will look at existing examples, and we will look at creating that portfolio when we invest the money. But it is a little premature for us to talk about our portfolio since we are still collecting the money in the market. But so the reason why I gave these examples, I know that these are well-known examples, is because just to make the point that I was making, that ultimately disruption leads to dramatic changes in the market, and that's where the winners and losers can really make a dramatic change in their fortunes. And of course, as Axis Mutual Fund, that will be our job to make sure that we don't that we have a good framework to make sure that we get the winners and losers. I would like to believe that many of you who are already invested with us over the last so many years, you would have seen that we at Axis Mutual Fund have done a fantastic job over the last 10, 11 years in terms of identifying companies which have a really good story in terms of their business model, in terms of their growth potential and sustainability, and have created a history of backing companies over the medium to long term as they transform themselves and translate that potential into actual growth and get that recognition in the market. And we've done that repeatedly over the years, and I think that is what really gives us the confidence that we can do a good job. We've also, I think, one of the things that Axis Mutual Fund we've really done is avoid companies which we think are not sustainable or which are really not able to respond to these type of challenges. And again, I think that holds us in good stead when it comes to creating the portfolio for this special situation fund in terms of what to avoid. There are questions about will this fund participate in IPOs? So I think again it ultimately is about finding companies which are relevant to this theme. As I explained at the beginning of the call, there is a difference between diversified funds and thematic funds, in the sense that thematic funds like these, which are focused on a particular theme, in this case, we are focused on disruption. So there are only stocks which are relevant to disruption which we want to invest in. But so therefore, even from an IPO perspective, if an IPO is of a company that is really a very strong case from a disruption perspective, etc., we will be very, very happy to participate. But if the IPO is from a company which is not really relevant in this context, then obviously we will look to skip. But IPO will be an important thing, as I was mentioning, that there are a number of these new age businesses which have gained scale over the last few years, and especially post-COVID, and we expect many of them to IPO over the next year or two. So that will be an important thing for us to look at over time. There is some question on why, how to look at the foreign allocation, or, why should we look at this fund versus some of the foreign funds which are out there. so I'll just make the point that this is, again, I go back to the fact that this is about targeting a particular theme. If you think as investors in our life day to day all around us, as we all recognize that there is a dramatic change taking place, and if you think that this will lead to a lot of changes in the way businesses will respond and the winners and losers that will happen, then it makes a lot of sense for you to have a dedicated allocation into a product that can participate in this theme or that can benefit from this theme. And that's where again the global thing comes into context, because basically when you look at the special situations fund, what we are trying to do is essentially use the same approach, whether it is the Indian stocks, whether it is the global stocks, and give you a comprehensive portfolio. So it's not about something being better or some other product being better or this product being better. It's about that this product has a very specific theme, and we are trying to make sure that we give you a perfect portfolio for that theme, which captures the opportunity all around the world, whether it's in India or abroad, and all across the market cap space. Um, uh, there is some questions on the overall market environment and the fact that markets are going up, and what the NFO at this time, what do we expect the market to do, given that we are at all-time highs as far as the Nifty Sensex is concerned. And the short answer to that is obviously we don't know how the market will do in the short term. Nobody does, and that's one of the challenges with equity investing, that in the short term things can always look uncertain, and there is always a risk of up and down. And therefore, we always encourage that all investors, whether it's large investors or small investors, should look at two things for sure. One is to have regular allocations. Don't just make a single ticket in allocation, because that's too much of a timing risk. And second thing is to have appropriate longer term horizon. Don't get swayed just because some market has done very well, or we had seen earlier this year when the markets had corrected sharply. A lot of people started canceling SIPs or stopped investing, and gross flows into mutual funds have really collapsed. I mean, that really doesn't make sense, because the whole point of regular investing is to benefit from the ups and downs of market. So if you invest when the market is high, but you stop investing when the market corrects, then the whole averaging concept will actually not really work, and the timing risk actually keeps affecting your portfolio. For the averaging to work, you have to be disciplined, and that's where SIP or STP becomes important. And make sure that you allocate across different levels, because then automatically then the averaging will play out. And if you have a reasonable horizon, we have seen time and again that if you spend time in the market 3-5 years longer, then these things the timing risk starts coming down quite materially as you make regular allocations. That is true for this fund as well. The only thing I will add is that being a new opportunity, a little bit of a lump sum in the NFO can be done in terms of being able to capture the exposure to this kind of a new opportunity. But obviously, regular investing has to be the name of the game in this one. The name of the fund, I hope it's clear by now, is Axis Special Situations Fund. That's the name. It's a thematic fund. There are some one question on saying that this is an excellent concept, but how can we be convinced that you can execute this concept in the correct way, or the way it has to be to capture the required value from this concept over time. Now, obviously, that is something being a new, as I said earlier also, that being a very, very new concept in the market, there is unfortunately no real history or track record that we can show that this is the way. Having said that, I think for many of you, as I said earlier, also have invested in our other funds in Axis, what you must have seen is that we really stand for good quality and stable portfolios. So that is one of the things we really have done very well over the years, which is to identify companies that have the ability to grow on a multiple year basis and stay invested with them over time. And disruption will also require that skill set. Invest early into a company, don't get swayed by hype, and do the hard work in terms of understanding the fundamentals, etc. And those basics cannot be, whether it is this theme or any other diversified portfolio, those basics cannot be compromised in terms of doing the hard work on fundamentals, hard work on understanding the quality, hard work on understanding the business models, etc. those things will have to be done. They are always essential part of creating any portfolio, and I think we have that required understanding and access to be able to do a good job of that, as we have demonstrated in a number of our other funds over the years. There's a question on, is there any other thematic funds that Axis has done earlier, and how's the performance? So we've just done one earlier this year, in fact, right in the month of January, which was what we call the ESG Fund. That was a fund that was designed to invest based on the entire sustainability concept, which is basically how companies have to look at not just financial parameters, but also how their linkages to the society, the environment, the society around them, and non-financial parameters in order to really make sustainable businesses. So we had launched the ESG fund earlier this year. Obviously, through a tough year, it's done really well. The numbers are something that you can see offline, but it's a fund that has done really well since its launch as well. There's a question saying that the majority of disruptors enablers are global in nature, and why are we limiting our allocation only to 30%? What is the story in India? So the answer is that we think that obviously one of the reasons for timing the launch now is that we think that even the Indian market, we've started seeing a fair amount of disruption taking place, and there are enough players now which are relevant. Maybe 2 years ago or 5 years ago, that may not have been the case. I also spoke about how COVID is leading to a big dramatic change in this regard. So we think that with all these things happening now in the Indian market, we have enough of a tailwind, enough of a momentum to be able to create a good quality portfolio. Ultimately, yes, the global market is much broader in that sense and offers a number of opportunities. We think that this mix of 70 India, 30 global is a great starting point for investors, because ultimately, for all of us, we are investors based in India, and we want to create portfolios which have allocations to Indian stocks or benefit from the opportunities that the Indian market brings to us. We may do dedicated global funds separately as well. In Axis, we have done one already last couple of months back, and we are looking to do more. So it's not about one avenue being better than the other, but the beauty of the special situations fund is that it gives you essentially a complete solution, in the sense that you get the combination of domestic and global stocks in one place. But yes, the most important thing is that yes, we think that the Indian market has now got enough opportunities, enough such names, potential, which is where we think that from a timing perspective, this was now the perfect time to launch a product like this. The question on the expense ratio, the expense ratio will be in line with any other equity fund of comparable size. We expect a really good, the fund is getting a lot of good demand from investors. The concept is something that is unique. The concept is something that is timely. The concept is something that people can appreciate and relate to their day-to-day lives. So which is why we believe that this fund is really getting a lot of very good demand. The fund launch has been ongoing for the last week. We expect the fund launch to be really successful and a very large NFO, and in terms of size. What I wanted to answer on the expense ratio is that essentially, therefore, the expense ratio is going to be aligned with any other fund of comparable size, equity fund that is of comparable size. There are some questions on the Global Alpha Fund of Fund, which we launched a couple of months back. How does this fund compare to that? So just Global Alpha Fund of Fund is essentially 100% feeder into a global fund managed by Schroders. It's a 100% global fund, point number one, and point number two, it's a dedicated diversified fund. As I was explaining, between diversified and thematic. So Global Alpha is basically best ideas from whatever sources, themes, wherever in the global context. Whereas the special situation fund, the big difference is, one is it's only 30% into global stocks, 70 into Indian, and point number two, it is all the stocks are going to be linked to this theme of disruptive change that we are talking about, and therefore it's a thematic opportunity and not just a diversified one. What is the ideal horizon for this fund? As I said, the market is slow to react to changes, these kind of changes, because they are not linear changes. Also, disruptive changes take time to play out. Look at the way we have transformed the whole telecom space in India in the last 5 years. There are changes which are afoot, but by the time the entire thing got momentum, and the way today that how seamlessly all of us can access bandwidth on our phones, it's just completely different from where we were 5 years ago, when we had to actually watch our internet usage or the data usage on our phone on a very careful way. So these are changes which can happen dramatically, but when you look back over 5 years, they seem like dramatic changes, but on a quarter-on-quarter basis, the changes can be slow and they may not really register for a number of years. And which is why we recommend people to look at this as a long-term allocation, because you don't know when the market will recognize the potential for this change and when they will start rewarding the company. As a fund manager, you want to be in early and you want to stay participated, because of the same reason, don't know how the markets, when the markets will respond. Eventually they will, if you're right, but they may take time, and that's where as an investor you have to be patient. And that's where we are recommending people to look at this as a long-term allocation. Like we said, maybe 5 years or longer is what we would encourage people to look at this kind of a product. There's a question on whether we will invest in unlisted companies. The answer is no. This is a listed equity product. We will invest in listed stocks, but we will also, along with the existing listed stocks, what we can look at is IPOs, companies which may not be listed today, but companies which get listed over time eventually in the market. There is a very important question about, how in the past thematic funds, especially so many of them which have been there for a long time, have not really done so well. And how do we believe, or what is the confidence that this particular offering of ours can do better? And the answer to that is very simple, that, all thematic funds can't be good and all thematic funds can't be bad. Ultimately, thematic funds, what is important is what is the theme behind that thematic fund, and whether that theme itself has two important things. One is it's a good theme that is going to remain relevant over multiple years. So for example, is disruption a theme that is a material, whether it is something that will remain relevant over multiple years? Answer is yes for both. And the second part of that is whether there are enough stocks or opportunities in the market that that you can get, which will benefit from this theme, and which the portfolio manager can use to put into their fund. And again, the answer is yes in the case of disruption. But in the many other thematic funds, we have seen that that is not necessarily been the case, and that is where perhaps somewhere the performance has gotten affected as well. There's some question on whether you can allow switches or whether you can move money around from one fund to the other. Yes, those things are easily possible, and switches can be done. Many of the questions, unfortunately, as I said, there are lots and lots of questions, and I'm really not going to be able to cover them. We are now maybe about more than close to 3,000 questions here, but what I'll recommend is that please reach out to us offline. We will share numbers, or you can reach out to us online as well. We'll try and cover all the questions as well on that. So I'll take a few more maybe just before we conclude, and there is a few questions which are sort of again coming up again on the market, and the fact that this launch is coming at a time when the market is at an all-time high. I did answer that, but let me reiterate. The opportunity is there, the growth potential is there. Markets will obviously go up and down, but if you are long-term, if you have a long-term horizon, we have seen time and again that equity is able to generate that kind of growth. Look at market peaks in the past. You look at 2000, you look at 2007, 8, you look at 2010. Markets were at their peak. Even investors who had the worst timing in terms of coming at the absolute peak, if they were patient and they remained invested over 7, 8 years, over longer terms, eventually they did make money. It's not that they did not. So ultimately, these things like market peaks or market troughs, they sound good for TV commentators, or they sound good for media people, but for an investor, ultimately these are irrelevant. If we are creating our portfolios for the long term, we want wealth generation in our portfolios for the long term, then what the market does in the interim really should not really concern us. As I said first, and I will repeat, only two things that we need to worry about. One is to make sure that we are regular in terms of our investments so that we don't get unduly affected by timing. And the second is that we should have a reasonably long horizon to allow the compounding and the wealth generation to take place in an appropriate way. There was a question on the fund manager for this fund. So obviously Axis Mutual Fund, within us we have a number of very strong fund managing professionals, and the manager for this fund is going to be Ashish Naik, who's going to be running this fund, who's also the manager behind Axis Equity Hybrid Fund and the Axis Triple Advantage Fund. There was a question on what is a mixture of large cap, mid cap, small cap on this fund. Broadly speaking, as I said, that we expect it to be broadly allocated to all the segments. Having said that, obviously we expect large cap to be a larger part of the allocation. So there could be, I would say, what is called a multi-cap mix. Basically, it have exposure across the spectrum with a bias towards the larger companies. That's the way we would look at this product. There is some question from the market. In the past, people have done funds which were called special situations, and many of them have not done well. And how does this compare? So I think that's a very important one for old investors who remember those funds. Special situations, of course, is a name or a tag. It can be used in a different context. Many of the managers use it in a context of more opportunistic types, where special situations are seen as opportunistic changes which are happening in a company which you can participate in the short term. This is not what we are trying to do in the special situations fund. We are trying to identify this as a special situation, which is the long-term disruptive theme that is happening around us. So we believe that the other funds in the market did not really use this vehicle for that long-term opportunity. And that is where our offering is completely different. Like I said, it's the first of its kind. I don't think there is any other fund in the market which has a comparable sort of a proposition for investors. There is question on the risk profile of this fund. Is it like riskier than a diversified fund, or how do we look at the risk of this product? See, ultimately, the reality is that the most important thing is that compared to a diversified fund, where this fund will differentiate is that it will be, very, very unique in its portfolio construct, because it will not try to cover the entire market, all the sectors or all the key stocks while creating the portfolio. It will obviously focus on those type of sector stocks, etc., which fall under this theme, which is the disruption theme. So in that sense, the departure from the benchmark will of course be higher, but that doesn't necessarily have to mean higher risk. What I said earlier, and I will just repeat that quickly, is that what it really means is that investors should have the appropriate horizon, because on a month-on-month basis, the performance of this fund could be different from the benchmark because of the specialized nature of the portfolio. And that's where the portfolio to play out, it may require a certain amount of longer holding period by investors. And we are encouraging people to look at this as at least a 5-year and longer allocation. And if you do that, then we are not too fast, because at an absolute risk sense, it may not be that much, but it's more about the fact that in terms of the stocks and the stories playing out, it will take longer allocation. There is one question on why don't we put global stocks in the tax saver, the long-term equity fund. The answer is that regulatorily, it's not permitted. We can only buy domestic stocks in that. There's a question on, will we look at launching a pharma fund in Axis Mutual Fund? The answer is we by and large don't look to launch narrow sectoral funds, because we don't think that sector funds have really done a good job in terms of creating wealth for investors over the long term. We want to create stocks or create products which are broad in nature, which can really add value to investors over the long term. And therefore we like doing funds where the themes are broad and relevant across multiple sectors, across multiple stocks. And that's where a special situation fund like this one is really something that we think has relevant. There's a question, maybe this will probably be the last one, that a lot of these, in hindsight, stocks like Amazon, etc., have been around for so long, and how have fund managers, etc., missed out on such stories? And that's exactly the whole point about this disruption theme, which is that invariably the normal day-to-day fund managers are focused so much, the markets are focused so much on the next quarter or the linear change, or how this quarter to next quarter companies are changing, that sometimes you miss the long-term changes which are happening. And that is where having a dedicated product like this allows the fund manager really to focus on this theme as the long-term theme, and to really do justice and make those allocations. And that's where really makes a lot of sense for investors to be able to get exposure to that theme through a product like this. Taxation wise, this is of course an equity fund, so it will be treated like an equity taxation. There were a number of questions on the portfolio, which unfortunately we can't really cover. But of course, once we launch it, like any other fund, you can see the portfolio in the public domain as well. So with that, I'll just quickly, maybe one or two more, but I think there's again a question on whether, can you please confirm if we will invest in foreign companies? I said this a few times, but I'll just reiterate. We will invest up to 30% into global stocks. In terms of which all countries, it is basically the mandate will be wherever the best ideas can come from today. If you look at the disruptive companies, they are all over the world. Some of them are listed in the US, some are in the Europe, UK, some are in Japan, China, Taiwan, Hong Kong. So there is no reason to limit ourselves to any one country or any few countries. The global allocation will really look for best ideas all over the world. So that 30% can really have stocks from any other any part of the world. Having said that, of course, US will have a larger allocation within that, because of just the sheer size of that market and the sheer size of opportunity which is available in the US. Um, 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 so I think there's one on taxation, equity taxation, and I hope all of us understand that short-term and long-term taxation, it requires you to hold for 1 year to qualify for long-term taxation. Less than 1 year qualifies for short-term capital gains on the equity side. The date of the launch, so we are in the middle of the NFO. We are middle of the launch. It's a 2-week launch. Out of that, 1 week's already gone through. So the launch period is running up till next coming Friday, which is roughly less than a week from now. So it's the fund launch. The fund NFO will remain open for another week, during which you can invest. And of course, subsequent to the launch, once the allotment is done, it will reopen as a normal open-ended fund, during which you can also make regular investments. There was a question on whether you can do SIPs during the launch. Of course, you can at any time, either during the launch or subsequently once it reopens. People can do SIPs in this fund, or STPs, or any other way of investing. So with that, thank you, everyone. I think it's been a long session. And like I said, unfortunately, we got a very, very large number of questions, almost a little under 3,000. We've probably not been able to answer a lot of you, but do reach out to us, and we will try and cover a lot of these questions on a listing basis. So with that, we're ready to conclude. Thank you, everyone, for joining us today, and we can conclude the webinar.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund
एक मिनट, I will say.